Okay, folks, very, very green day. The market is always quite fascinating. The worse things are feared to be, and the more time people are given to ruminate and speculate on it, the worse the market drops. But then when actually bad things happen, like an invasion of a major European country, international sanctions cutting off a huge supplier, or out-of-control energy prices accelerate an already out-of-control inflation, the market's just like, yep, let's buy. It's really fantastic. Today, at least when I shot this video, you had the Dow up 2%, the S&P up over 2%, NASDAQ just under 2%, and the Russells up 2.5%. I used to call the Russell small caps the Ruskis because it has Rus and then it has 2K, and I thought Rus and K Ruski. But as of late, for some reason, I've decided that's not the best idea. But speaking of the Ruskis, the Russian stock market has been paused, but boy, there's just been a huge capital exodus out of anything Russian related, especially on external listed markets. Putin would make quite an awful hedge fund manager. And reportedly, Russia is planning to spend up to $10 billion from its rainy day fund to help prop up their market once it finally reopens, which for scale is basically a speckle of dust compared to the US market. That wouldn't do anything in our markets. Elon Musk alone probably loses and gains $10 billion every other week. But overall, certainly tough times in Russia. You have their top bank quitting Europe amidst sanctions. There's been a huge run to get assets out of banks that have connections to Russia for obvious reasons. And this particular bank said they are no longer able to supply liquidity to European subsidiaries following an order from Russia's central bank, which is seeking to preserve foreign currency. Sberbank shares listed on the OTC market have gone down a casual 93% since February 15th. And you thought innovative tech stocks were bad. Oof, this is a whole nother level, folks. But it's also the third largest bank in Europe. Certainly going to have some dramatic impacts for the global financial system. And of course, you look at who owns Sberbank. Well, it's of course half owned by the Russian National Wealth Fund, managed by none other than the government of Russia, which of course is very, very similar to what we saw with the major oil companies that we did a breakdown on a couple days ago. And of course, the rest of the shares here as well are likely owned by, well, Russian party affiliates and leadership loyalists. Oligarch's gonna oligarch, right? Meanwhile, the Russian ruble is down 25% when compared to the US dollar in the last few weeks, and while Russia's energy segment hasn't been directly targeted by Western sanctions, many big oil companies don't want to work with Russia out of fear of being caught between the crossfires of further sanctions and further Russian action. And big companies in all major sectors are suspending their operations and investments in that region. Apple, the biggest company in the world, has halted product sales in the country. They've also removed Russian news organizations like RT and Sputnik from the App Store. Airbus and Boeing are halting supply of aircraft parts to Russian airlines. Oracle, same thing. And it's not just capital and assets that are leaving in mass. Think about all the Russians that are employed by these foreign companies that have offices and have operations in Russia. All of those people are now without jobs. When these jobs are going to come back is very, very unclear. Nobody wants to invest in an entire region that is now increasingly uninvestable because you don't know what the future looks like for it. The economy is being bludgeoned and there's no end in sight. Even if the invasion stopped tomorrow, it's not like all of these companies are going to come back immediately. It took Russia a very, very long time to build out Western relationships and trust. Now that all that has been broken, hey, it's going to take a long time to build that back if they even try to. Even if you're a company that's pro-Russia and a Russian sympathizer, which I don't know how you can be in this mess, it still doesn't make much business sense from a risk versus reward standpoint. You're going to have delays, intense scrutiny, and you could possibly lose your entire investment or your right to transact in other markets depending on how severe these sanctions end up being. So obviously you have a lot of panicking over in that economy. The Russian government has gotten so desperate that they ordered exporters to exchange 80% of their foreign currency reserves for rubles and banned Russian residents from making bank transfers outside of the country. And yesterday, the government said Putin was working on a decree that would prevent even foreign companies from exiting their Russian assets, in addition to a decree he signed earlier to ban people from taking more than $10,000 in foreign currency from the country. I mean, it's a desperate situation over there. You have to create laws to stop people from dumping your currency in mass. And for the ruling class over there, the oligarchs, it's a bad time. Oligarchy isn't as fun as it used to be. Oil companies and national banks that they own a ton of shares in are getting killed. Assets held abroad are being potentially frozen. Travel restrictions are being implemented heavily, and there are anecdotes of mega rich oligarchs moving their yachts around to stop them from getting seized. Back in high school and college, I remember considering oligarchy as a potential career path. Lots of job security, free vodka, and Putin favors. But close call, glad I didn't choose that route. But anyways, moving back home to the Fed, what just happened today? Jerome Powell spoke. You could read or watch the entire Powell of Jerome speech, but I got 3 big takeaways. Number one, the Fed acknowledges increased uncertainty in regards to this Ukraine situation, but isn't willing to take accelerated preemptive action in order to stop that uncertainty from playing out in a negative way for the economy. Rather, it wants to continue its wait and watch the data approach and then react if necessary, which is basically saying so far they're not changing their trajectory. Number two, the Fed has acknowledged that if the data suggests that it needs to, it will raise rates by more than a quarter-point hike at a meeting. He hinted very strongly that that's not going to be this meeting. Number three, though, he still sees inflation as very, very supply chain driven, which is of course a fancy way of saying that it's still transitory to a large extent, without saying that it's transitory because that's a very mocked word these days. Basically, by saying that, he's acknowledging that the Fed isn't going to be the primary force in bringing down inflation, it's going to be supply chains healing, which of course is extremely bold considering that energy prices are skyrocketing and energy prices have already been driving a lot of inflationary pressures the last few reports. But overall, the biggest takeaway from Jerome Powell's speech today is that despite a lot of the geopolitical uncertainty and overall supply chain uncertainty and overall out of control inflation uncertainty, their most likely trajectory is still a quarter rate hike per meeting. And that kind of explains why the market did so well today. The market has been trying to factor in what the Fed's going to do, and it's been leaning more and more towards a half-point hike this month. With the Fed subtly signaling that that's not going to happen, it's given the market some room to sigh a sigh of relief. But overall, I think there was an argument to be made that even if he came out and said that it was going to go up a half point, the market would still sigh a sigh of relief because they'd be like, okay, now we have some certainty, something to grasp onto. It's the uncertainty that really, really freaks out the markets, because a lot of people would just rather take a huge L than deal with any sort of unknown in the short run, right? And a lot of algorithms play off that fear, accelerating both sides of the move. Okay, now moving over to short-term trading opportunities. This has been a very, very interesting and increasingly lucrative traders market. We have been working our best to find short-term catalyst runners for the daily morning briefings in ZipTrader U. One of the ones that did really, really well this week is Mullen. MULN was running up massively after it announced progress on its solid-state battery pack development. Mullen Automotive is another electric vehicle hopeful, trying to build a name for itself, and of course those always make good catalyst plays, especially when something comes out in regards to a battery. We briefed on it at about 30 minutes prior to market open on Monday at about $1, and it more than doubled going to $2.14. I had noticed in the days before that it was getting a lot of attention on retail forums, and in that pre-market morning you started seeing that attention go parabolic, and I thought this news catalyst had a lot more room to run, especially after market open when the rest of the market started realizing what was going on. And it was also very, very low float, which made it likely that any sort of catalyst that gets at attention would cause a massive rally. And in this case, that did work. But of course, catalyst plays never ever retain their immediate reaction, whether it's euphoric or dysphoric. And likewise with Mullen, after provided an insane run, ended up dropping just as much afterwards as people took profits. For our short-term traders, make sure that you understand that you have to always have a clear entry and exit plan. One that has a set criteria list that says, okay, this is what's going to need to happen for me to enter a position. You're going to need to see some price strength confirmation, and this is what's going to need to happen for me to stay in the position. Once you start seeing that break of price strength below your SMA line, once you start seeing that stop loss being hit, then all of a sudden it's like, okay, well now it's time to lock in that momentum rally, and there's no way to do that perfectly, right? If it was easy to do that perfectly, everybody would do it. But the key is to grab most of the move most of the time, and then you walk away. Another one from the briefings is IMPP, which was up another 39% today. IMPP is a spec oil disruption play that we've briefed on almost every day since the morning of February 22nd, when it was around 66 cents, and it climbed to 282 at highs and looks to be priming itself for another breakout. So I mean, even though this hasn't been much of a conviction market or a long-term traders market, there are some short-term trading opportunities to be had. I can't promise you that we'll always be able to find huge runners or that market conditions are always going to have huge runners, because that's a cyclical thing, but I can promise you that we will do our best to present you with opportunities every single morning in the daily morning briefings, as well as of course give you lifetime access to our resources that allow you to download my entire stock market brain and hopefully give you a strategy to play them yourselves as well as find them yourselves. And of course give you a full list of our price targets for our conviction plays as well. And we're increasingly going to be building out some more price target lessons on how to set them, how to analyze stocks, how to upgrade and downgrade, and so on and so forth. If you'd like to join us at ZipTrader U, I'll go ahead and put the link below, but you already know about that. Moving on over to longer term plays, ChargePoint. So ChargePoint had earnings today, very solid, and the stock went up in the after hours. ChargePoint operates on a fiscal calendar that is completely different than the standard calendar that we're on, so keep that in mind when we're reading this data. They're reporting for 2022, but in reality they're talking about 2021. But their latest report was very, very positive. They showed a dramatic increase in hardware sales, aka the charging systems themselves, and likewise subscriptions and other revenue as well. Now remember, the business model of ChargePoint is a one-time hardware sale, selling the charging station infrastructure itself, and then those customers that pay that upfront fee also pay a reoccurring subscription revenue, which means that every single person that ChargePoint can sell hardware to is now a long-term customer as well. And in the future, you can expect hardware to go up and down, but subscription should increasingly form the backbone of ChargePoint and increasingly go up, because the more customers they add, even if they're adding more or less customers, the more subscriptions they're going to have on an overall uptrend. In total, revenue was at 80.6 million, which was above most analyst expectations. Google says the expectation was 76.13. Meanwhile, quarterly revenue increased 90% year over year, and annual revenue increased 65% year over year. Both came in above guidance. And they expect 450 million to 500 million in revenue for fiscal year 2023. Overall, this earnings report shows that ChargePoint is not just making dramatic progress, but it's also keeping its leadership position in this niche. And the niche is set to really grow as EV adoption grows. This company is achieving more than I thought it would from a fundamental stance. But obviously, when it comes down to the stock itself, not performing well, Susan. And oftentimes these days, when companies report nice, massive beats in the after hours and run in the after hours, people just see that as an opportunity to sell out of the stock and get their cash out before the rest of the market sells off more, which is quite unfortunate, and it is what it is. For long-term conviction traders, this isn't a great market. It's a great market to get cheap stocks, but it's not a great market for instant gratification. Let's just say that. So keep that in mind. Right now, fear dominates everything. It doesn't matter what these companies report. They could report 5,000 times what analysts were expecting, and the stock would go up, and then the next day people would say, okay, great, now it's time for me to sell out and lose less cash. We are in a defensive trading market. We're not in an offensive market. We're in a market where people aren't asking, how can I make money? We're in a market where people are asking, how can I lose less money? And they're trading just like that. But keep in mind, over the long run, the market is more offensive than it is defensive. And right now, you're just in a fear period. That's fine. Be aware of that, but also be aware that the best time to exploit and find companies that are performing well fundamentally is during these fear periods. That doesn't have to be ChargePoint. I like ChargePoint, but it doesn't have to be ChargePoint. It can be any company that you have a lot of conviction in that is also showing consistent growth on a long-term uptrend. Because remember, I don't want to show this every single night, but long-term returns are dictated by one thing, the growth of revenue. But anyways, folks, that caps off today's video. If you have any questions, feel free to reach out to us below or join us on ZipTrader Circle. If you'd like to learn how to trade with our private chat, our daily morning briefings, our full price target list, and most importantly, our step-by-step lessons on how to trade and operate in the stock market, well, I'll go ahead and put a link to ZipTrader U below. Coupon code never give up, because it's very important never to give up in these trying market conditions. This is the time where you hunker down and you start really building that account and you set yourself up for success in the future. Check that link out below if that sounds like something that will interest you. Have a good one, and we'll see you in the next one.